I want to show you a number. Not my phone number, but a number published this week by a serious institutional analyst that made the entire precious metals community stop in its tracks. $3,947 per ounce of silver. Now, before you click away or file that under tinfoil hat territory, just stay with me for the next 30 seconds. I spent the last several days breaking down the actual math behind that figure. Every ratio, every historical comparison, every single assumption. And here's what I found. The headline number might sound extreme, but the logic is surprisingly solid. In fact, when I intentionally watered down every input, making them as conservative, cautious, and even boring as possible, I still arrived at a silver price that should force anyone watching this to seriously rethink how much they're re-holding. Today isn't about that flashy target, it's about the math underneath it. Because math doesn't care about narratives, opinions, or headlines, and what the numbers reveal about silver's real trajectory, even in the most restrained version of this framework, is something the mainstream financial press simply won to walk you through. Ladies and gentlemen, Active John here. Welcome back to the channel. The market may be closed for the weekend, but Friday's closing data gave us a snapshot that deserves our serious attention. Let's look at the numbers. Silver closed the week at $84.52 bid. The weekly high was $84.85, and the weekly low was $77.39. That's a massive 7.77% gain in a single week. Meanwhile, gold closed at $5,151.90 bid. It hit a high of $5,187.70 and a low of $4,980.90. That represents a 2.22% move for the week. Now, these numbers aren't exciting just because they're big. They're important because they confirm that something structural is shifting under the surface of the market. There's a fundamental change happening right now, and the closing prices are just the symptom. Once you understand the three critical ratios we're about to break down, those prices you just heard won't look the same by the end of this video. The first ratio we need to talk about is the classic gold to silver ratio. For centuries, this has been a key metric for valuing the two metals against each other. Historically, the ratio has hovered around 15 to 1, meaning it took 15 ounces of silver to buy 1 ounce of gold. In the 20th century, it averaged closer to 50 to 1. Today, it's sitting at a much wider level, suggesting silver is significantly undervalued relative to gold. When this ratio starts to compress back toward its historical average, the upward pressure on silver's price will be immense. The second ratio is the Dow-to-Gold ratio. This measures how many ounces of gold it takes to buy 1 share of the Dow Jones Industrial Average. At major market peaks, this ratio can be extremely high, like it was in 1999. At major market bottoms, it can drop to as low as 1 to 1. Right now, we're far from that bottom. A reversion to the mean here implies either a much lower stock market, a much higher gold price, or a combination of both. And remember, where gold goes, silver often follows with even more leverage. The final, and perhaps most important ratio for silver, is its relationship to the total money supply. As central banks continue to print currency at an unprecedented rate, the value of each dollar, euro, and yen decreases. Physical assets with a finite supply, like silver, naturally become more valuable in this environment. When you look at the amount of silver available above ground compared to the trillions in new currency created, the math becomes startlingly clear. There simply is not enough physical silver to go around if even a small fraction of that new money decides to seek a safe haven. So when we put it all together, the historic undervaluation compared to gold, the potential for a major shift in the stock market, and the unstoppable expansion of the money supply, that institutional price target starts to seem less like a wild guess and more like a mathematical destination. The weekly moves we just saw are not a fluke. They are the early tremors of a much larger shift. The real question isn't if silver will revalue, but how violently it will happen when the mainstream finally catches on. The numbers are telling a story that most people aren't ready to hear yet. But for those paying attention, the opportunity is right in front of us. It's not about hype, it's about arithmetic. All right, let's talk about silver. I see so many people getting excited, watching every little tick of the candle, celebrating every small weekly gain. Everyone's got their eyes glued on that magic number. Maybe it's $84 an ounce. And look, reaching that price would be fantastic, no doubt about it. But I need to tell you, $84 isn't the real story here. It's just a single chapter. The real epic novel is the gap. What gap am I talking about? I'm talking about the massive distance between where silver is trading right now, today, and where it should be trading based on solid historical data. This isn't just one person's opinion or some wild guess. We're talking about 3 independent, historically proven ratios that all point to the same conclusion. Think about that for a second. 3 completely different calculations, using 3 separate sets of inputs, and following 3 unique methodologies. And yet, when you run the numbers, they all converge. They all scream that silver is in a league of its own, far above its current price tag. When you start to grasp how these ratios work together, how they paint a much bigger picture of the financial landscape, your perspective on silver completely changes. Suddenly, a price like $84 an ounce does not look like a final destination or a mountain peak to celebrate. Instead, it starts to look like the beginning of the runway, the launch pad for something much, much bigger. That gap, that vast space between today's price and its historically justified value, that is where the true, life-changing opportunity is hiding in plain sight. You see, there's a fundamental difference in how people are viewing this market. Most retail investors are caught up in the day-to-day noise. They're focused on those weekly candles, the short-term fluctuations, the chatter on social media. It's like watching the waves on the surface of the ocean. But the big players, the institutions, they aren't watching the waves. They're studying the deep ocean currents. They focus on structural mispricing. They look for assets that are fundamentally, mathematically, and historically undervalued compared to the rest of the system. And right now, silver is arguably one of the most structurally mispriced assets on the planet. Its current price doesn't even begin to reflect the economic reality that is bubbling just beneath the surface. I'm talking about the mountains of debt, the currency devaluation, the simple, undeniable laws of supply and demand. When you weigh silver against the sheer scale of the global debt situation, you realize it's not just underpriced, it's dramatically, almost absurdly underpriced. So while many are getting distracted by the daily price movements, the smart money is quietly accumulating. They understand that this isn't about timing the perfect weekly entry. It's about positioning for an inevitable long-term revaluation. It's about recognizing that the gap between perception and reality is a powerful force. And as that gap begins to close, and it will, the energy released will be incredible. The story of silver isn't about chasing a price target. It is about understanding its true role as a store of value in a world drowning in debt. It's about seeing the gap for what it is, a once-in-a-generation opportunity. So, the next time you look at the price of silver, don't just see the candle, see the runway. Ever wonder what a fair price for gold and silver really is? Forget the day-to-day market noise for a second. Let's look at the bigger picture, starting with the foundation, the connection between U.S. government debt and its gold reserves. This relationship tells a fascinating and somewhat shocking story. Back during World War II, things were very different. The U.S. had a mountain of debt, just like today, but there was a crucial difference. A staggering 51% of that federal debt was directly backed by physical gold held in reserve. Think about that. For every dollar of debt, there was a significant tangible asset behind it. Half of the entire national debt was covered by gold. Fast forward to today. The United States still holds a massive amount of gold, about 261.5 million troy ounces, tucked away in its vaults. That gold hasn't gone anywhere. But something else has changed dramatically. The debt. U.S. federal debt has exploded into the tens of trillions of dollars. It's grown so much that the gold sitting in the vaults has been completely overshadowed. So what percentage of the federal debt does that same gold back today? Not 51%, not even close. Today, that same 261.5 million ounces of gold backs roughly 3% to federal obligations. 3%. The gold didn't leave the vault, the debt just grew into a skyscraper around it. This collapse from a 51% backing to a mere 3% is the reason you sometimes see those headline-grabbing, almost unbelievable price targets for gold. For example, have you ever seen an analyst predict a $75,000 gold price and wondered where on earth they get that number? Well, it's not just pulled from thin air, it's based on this historical context. Let's run the numbers together. It's simpler than you might think. If the U.S. decided to revalue its gold reserves to once again back 51% of its current federal debt, the total value of those reserves would need to reach about $20 trillion. So you take that $20 trillion figure and divide it by the 261.5 million ounces of gold the U.S. holds. What do you get? You land right around $75,000 per ounce of gold. Now, what does this mean for silver? Historically, the gold to silver ratio has fluctuated, and that's a fair point. A return to a 51% backing is a huge leap. So let's be more conservative. Let's water down the assumptions and see what happens. What if we don't aim for 51%? Let's say we cut that assumption in half to a 25% gold backing for the national debt. Where does that put the price of gold? Still at an incredible $37,000 per ounce. Okay, let's get even more realistic. How about we use the level from 1980? Back then, gold backed about 18% of the federal debt. If we return to that level today, the implied price of gold would be around $26,000 an ounce. Still a massive increase from where we are now. Let's push it one step further. Let's be extremely restrained and drop the assumption to just a 10% backing. Even at that modest level, for gold to cover just 1/10 of the federal debt, its price would need to reach about $15,000 per ounce. What this thought experiment shows is that even under the most conservative, watered-down scenarios, the fundamental imbalance between the amount of debt and the current value of gold is enormous. If history is any guide, and if gold is ever called upon to play a more significant monetary role again, its current price doesn't even begin to reflect its potential. The numbers suggest a future where precious metals are valued very, very differently. Let's talk about another critical ratio. The Dow Jones Industrial Average priced in ounces of gold. This is a powerful tool. When this ratio is high, it means stocks are expensive compared to gold. When it's low, gold is the expensive one. Think about it like a seesaw. Historically, this ratio gives us some incredible insights. It peaked way back in 1929, right before the Great Crash, and then collapsed into 1933. It did it again, peaking in 1966 and then collapsing into 1980, the all-time high. That was in 1999, when the ratio hit an insane 44.8. That means it took almost 45 ounces of gold to buy the Dow. So where are we today? Right now, the ratio is sitting around 985. To give you some context, back in 1973, just before the massive bull market in gold really took off, the ratio was near 10. What happened next? From that point, it plunged all the way down to 1 by 1980. 1 ounce of gold could buy the entire Dow Jones. During that period, gold skyrocketed from around $180 to $850 an ounce. And stocks? They basically went nowhere for a whole decade. It was a lost decade for equity investors, but a golden era for precious metals. Now, let's look at the future based on this historical pattern. The analysis I've been studying is actually quite conservative. It's targeting a future ratio of 2.5, not the extreme low of 1 we saw in 1980. So let's play with some numbers. If we imagine the Dow stays steady, let's say near 40,900, and this ratio compresses down to 2.5, what does that mean for gold? Do the math. Gold would need to reach roughly $19,800 an ounce. That might sound extreme, so let's be even more conservative. What if the ratio only falls to 5? That's still well above the historical bottom. Even in that scenario, with the Dow at 40,900, gold would land near $9,900 an ounce. See the pattern here? We're using different inputs, different assumptions, but the conclusion points in the exact same direction, a significantly higher gold price. And this brings me to the grand finale, the cherry on top. What about silver? Here's a fascinating and consistent piece of history. When gold enters a major bull market and that Dow-to-Gold ratio starts compressing, silver doesn't just follow. It outperforms gold. And I don't mean sometimes. I mean every single time this has happened in the last century. Every single time. This isn't just a coincidence or a random fluke. It's a structural part of how these markets work. The financial gears are interconnected in a way that when gold accelerates, silver gets an even bigger boost. So as we watch this ratio continue to evolve, it's not just telling us a story about gold. It's potentially signaling an even more dramatic move for silver. It's a setup that has played out repeatedly, and all the signs suggest we could be on the verge of seeing it happen again. Keep a close eye on this ratio. It might be one of the most important charts for the decade ahead. Okay, let's talk about the third and final key ratio that could signal a massive opportunity in the silver market. The gold to silver ratio. This is a big one, so stick with me. Right now, this ratio is hovering around 60 to 1. That means it takes about 60 ounces of silver to buy 1 ounce of gold. But this number isn't set in stone. In fact, it swings wildly. Just to give you some context, back in March of 2020, during that market panic, the ratio skyrocketed to a historic high of 125 to 1. Silver was incredibly undervalued compared to gold at that moment. Now, let's look at the other extreme. In January 1980, during a major precious metals bull market, the ratio collapsed all the way down to just 14 to 1. That's a huge swing, and it shows you how volatile this relationship can be. Now, you might have heard some extreme predictions out there, like a target of 19 to 1, which would imply a silver price of nearly $4,000. It's important to understand that this specific target was based on a very unique, once-in-a-lifetime market situation involving highly concentrated buying pressure from a few very wealthy individuals. And while it's exciting to think about, we need to stay grounded in historical reality to make sensible projections. Let's look at what's more typical. During the big precious metals bull market of the 1970s, before those market distortions happened, the ratio consistently compressed to a range of about 30 to 35 to 1. That was considered normal for a bull market. Fast forward to the more recent bull run in 2011, where did the ratio go? It hit 31 to 1. See the pattern? That 30 to 40 range seems to be the historical sweet spot for where the ratio naturally settles during strong bull markets for precious metals. It's a much more realistic and historically supported benchmark. So let's take this more reasonable range and apply it to our future price scenarios for gold. Remember that projection we talked about where gold could reach $19,800 an ounce? Let's see what that means for silver. If we apply a historically normal ratio of 35 to 1, silver's price would be $566 per ounce. That's incredible. What if the ratio compresses even further to, say, 25 to 1? Well, at a gold price of $19,800, that would put silver at $792 per ounce. The potential is just staggering. But I know what some of you are thinking. Those numbers sound almost too good to be true. So let's be even more conservative. Let's tone down our expectations significantly. Let that sink in for a moment. We've deliberately dampened every single assumption. We've used a lower potential price for gold, and we've used a conservative, historically backed ratio instead of a wild, once-off extreme. And even with all those conservative adjustments, the math still points to a silver price of $428. If silver were to go from its current levels to $428, you'd be looking at a massive increase in value. This is what makes the current setup so compelling. When you look at the fundamentals, when you look at the historical data, and when you apply conservative, reasonable assumptions, the potential upside for silver is truly life-changing. The numbers speak for themselves. The gold to silver ratio is a powerful indicator, and right now, it's signaling that silver might just be one of the most undervalued assets on the planet. We've covered a lot of ground today, looking at these different ratios and what they could mean for the future. I hope this analysis gives you a clearer picture of the potential that lies ahead. As always, do your own research, but the historical patterns are hard to ignore. All right, let's talk about the bear case for silver. It's something you hear all the time. Higher prices will just bring on a flood of new supply from miners, right? It sounds logical. The price goes up, mining companies get greedy, they dig more out of the ground, and that new supply crushes the rally. Simple economics. But when you actually dig into the details, that argument starts to look pretty shaky. The biggest problem with that theory is the timeline. It assumes that you can just flip a switch and get more silver. You can't. From the moment a new silver deposit is discovered to the day it actually starts producing metal, you're looking at a 7 to 10 year process. That's a decade. Think about everything that involves exploration, feasibility studies, securing permits, which can be a nightmare of red tape, financing the entire project, building the mine, the infrastructure, the processing plants. It's a massive, expensive, and incredibly slow undertaking. Now, compare that to how demand works. Macroeconomic shifts, like a surge in investor fear, a currency crisis, or a sudden realization of silver's industrial importance, don't happen over a decade. They happen in months, sometimes even weeks. We see these huge, powerful waves of demand crashing into the market. So you have demand moving in these fast, powerful waves, while supply can only inch forward over a period of years. The two are on completely different clocks. It's a fundamental mismatch. And here's the kicker. We're not even starting from a balanced market. Silver has been in a supply deficit for years now, consecutively. That means even with the prices we've had, the world has been consuming more silver than all the mines and recycling combined could produce. The deficits haven't been closing. In some cases, they've been getting wider. Why? Because the demand side of the equation is not just holding steady, it's accelerating. Think about the industrial demand. This isn't some niche application anymore. We're talking about foundational technologies for the 21st century. Solar panels are a huge one. Every single panel needs silver. As the world pushes for green energy, that demand is locked in and growing. Then you have semiconductors, the brains behind every electronic device we own. The more advanced the chip, the more silver it often needs. And don't forget the defense industry, which uses silver in everything from missiles to electronics. This isn't speculative demand. It's real physical consumption that is expanding every single year. This industrial importance is so significant that the United States has officially designated silver as a critical mineral. That's not just some fancy label. It's a strategic classification. It means the government recognizes that silver is essential for national security and economic stability. This adds a whole new layer to the demand story, placing it in the same category as other strategic materials vital to the country's future. It's no longer just a monetary metal, it's a strategic asset. Now, another point the bears love to bring up is that central banks aren't buying silver. They'll say, look, central banks are loading up on gold, but they're ignoring silver. That puts a ceiling on the price. And it's true. For now, central banks are largely focused on gold. But I see that completely differently. That's not a ceiling, it's untapped potential. It means that a massive category of buyers, arguably the biggest and most price-insensitive buyers in the world, haven't even entered the silver market yet. Think about what happens if even a handful of central banks decide to diversify a tiny fraction of their reserves into silver, recognizing its strategic industrial importance. That's not a headwind, it's a call option. It represents a whole new wave of demand that could be triggered at any moment. So when you put it all together, The idea that a simple supply response can cap silver's price just doesn't hold water. Supply is slow and constrained while demand is fast, growing, and diversifying. We're already in a multi-year deficit, and the industrial and strategic importance is only just beginning to be recognized. The fact that central banks are still on the sidelines isn't a weakness. It's one of the most explosive potential catalysts waiting in the wings. How high could silver and gold prices go? It's the question on every precious metals investor's mind. Today, I'm going to share my personal framework for looking at future price potential. This isn't a prediction, it's not financial advice, and it's definitely not a guarantee. It's simply a framework based on historical data and ratios that I use for my own long-term strategy. Think of this as a way to visualize what could be possible under certain economic conditions. Let's start with what I call the conservative case. In this scenario, we see gold reaching $15,000 per ounce. Now, historically, the gold to silver ratio has compressed significantly during bull markets. A return to a more traditional ratio of 35 to 1 isn't out of the question. So, if we take a $15,000 gold price and divide it by 35, we get a silver price of about $428 per ounce. Again, this is the conservative end of my framework. It assumes a significant but not unprecedented move in gold and a historical reversion in the gold to silver ratio. For many, this price point for silver would already be life-changing. But it's just our starting point for this thought experiment. Now, let's explore a more moderate case. Some analysts, using models based on monetary supply and historical valuations. Finally, let's look at what I call an optimistic but still grounded case. We'll stick with a $19,800 gold price from the moderate scenario. But what if the gold to silver ratio compresses even further? In past major bull markets, we've seen this ratio dip below 20. For this optimistic scenario, let's use a more conservative ratio of 25. A ratio of 25 to 1 is still well above the historical lows, but it would represent a massive revaluation of silver relative to gold. So if we take $19,800 gold and divide it by 25, we arrive at a silver price of $792 per ounce. This is a scenario where silver truly shines, not just riding gold's coattails, but dramatically outperforming it as both a monetary and an industrial metal in high demand. So when could all this happen? Looking at the cycles of past bull markets, from their start to their speculative peaks, a realistic timeline could place this potential peak somewhere between 2030 and 2033. This is crucial to understand. This is not a momentum trade. We're not talking about something that's going to happen next week or next month. This is about establishing a long-term position. It is about understanding the macroeconomic shifts at play and having the patience to see the cycle through. The people who benefit most from these moves are the ones who accumulate during the quiet years and hold with conviction. This framework helps me maintain that long-term perspective. It's about seeing the potential and positioning yourself accordingly for the long haul. What do you think of this framework? Do you have your own models for projecting prices? Let me know in the comments below. I read every single one. And if you got value from this breakdown, please hit that like button and subscribe for more deep dives into the world of precious metals. Thanks for watching.